as India's most profitable NBFC, delivering balance sheet growth exceeding 30% and ROEs exceeding 20%, also with best-in-class NPA rates. He is credited for setting up the Bajaj Analytics Center of Excellence, which has established BFL as India's premier practitioner of analytics. Ladies and gentlemen, please join me in welcoming Mr. Bharath Vasudevan, Enterprise Risk Officer, Bajaj Finance Limited.
It's an honor to be here to present in this August conference. I was joking, I have not been in a room with so many suited people in a long, long time. So, when the CIBIL team first asked me to present, as in what do you want me to talk about, they said, how do you drive customer satisfaction and profitability using analytics? I said, no, I can't talk. It'll take me weeks to prepare a full-day workshop. They said, no, we want you to present it in 30 minutes. So I said, okay, I'll give it a try. So here's our story. Now, there are many ways you can tell a story about how to use analytics to drive profitability and customer satisfaction. For our part, I shall use the lens that I'm most comfortable with, which is how Bajaj Finance has done it. Specifically, it's my take on how Bajaj Finance has done it. So here goes. So I assume I don't need to introduce the company. I think by now, over the last few years, especially, everybody knows about us. But high level, Bajaj Finance Limited is part of the larger Bajaj Finserv group, which has two holding companies which do general and life insurance, and Bajaj Finance, which is the NBFC that I work for. The reason I'm here to talk to you about is the bottom 3 points here. We have a franchise, as of December last year, was approaching 25, now north of 25 million customers. We are originating at a run rate more than 5 million loans a quarter in over 1,000 locations, right? And that's always interesting for people to know how you manage these things at scale and how you do it profitably and how do you do it with customer delight, which is what I'm here to talk about. Now, Bajaj Finance is present, we believe, in a full suite of products. We are a non-bank with a bank-like strategy. But I'm not here to talk to you about this. I'm really going to talk to you about our sales finance business, which is consumer durables, fridges, washing machines, mobile phones, so on and so forth, how we lend at scale, and we are still the dominant player in this space. What we do in this space is what I will be talking about. So what's our journey so far, right? We have been at it for a while. The current avatar of Bajaj Finance started about 10 years back when both our Vice Chairman, Mr. Nanu Pamnani, and my boss, Mr. Rajiv Jain, came on board. And there's really quite a transformational journey. So it's a very different company from the time. 10 years ago, in 2008, we did less than 1 lakh accounts in the full year. More interestingly, we used to have thick files, right? Thick files, and took 3 days approval. And I had not coordinated with Amrita on this point, but I'll still make the discussion about how it went. And we were present in only 50 locations, right? And I talk about this, and I'll come to this point again and again. I personally believe paper increases rather than reduces risk, but it's an interesting perspective. I think many bankers love to collect lots of papers to underwrite. Our direction is firmly the opposite. Today, our volume is about 100 times of what we used to do then. The peak day for consumer durable lending is the day of Dhanteras, the day before Diwali. Last year, we did more in that one day than we did all year in 2008. We did more in that one day than we did all year in Diwali in 2008. The amount of paper we collect has come down. In specific instances, it's as little as 1 paper, which is ECS. In other customers, it may be a few more, but it's much, much, much fewer than the 30 papers per customer. Our approval time is 3 minutes, meaning once the customer stands in the counter and reaches a counter, as long as nobody is standing ahead of him, the entire approval process takes only 3 minutes. And that is for a new customer, be it new to credit or not new to credit. So with or without a CIBIL hit, it's 3 minutes. If it's an existing to Bajaj customer, it's 3 seconds, right? They give their phone number or an identifier, we dedupe against their limits and proceed. De facto, we have a base of 10 million plus customers who have a closed loop plastic of 10 million plus where the approval is just 3 seconds. And we are present in over 500 urban locations. If I had rural locations, there's another 500. So 1,000 locations, this dramatic scale. And you're not satisfied with this. We want to multiply the velocity. I think earlier on, we talked about India's consumer debt to GDP, right? At 11 and 12%, we firmly believe it's very, very low. Now, Australia, they showed was 120, US is 70 or China is 30 something. Fact of the matter is, consumer debt is going to increase, right? As prosperity increases, consumer debt increases. Credit growth tends to be 2.5x of nominal GDP growth. So there's no reason why we cannot significantly and actively and rapidly grow our share. But if we have to do that, we want to move towards no paper, zero paper. We want to move towards instant disbursals. And we want to be present in thousands of locations, right? And there are very, very successful banks which are present and doing lending in thousands of locations. In fact, the general lesson is the more you move away from the urban centers in India, the more profitable your business gets. Risk is lower, pricing power is higher, so on and so forth. That's our intent as well. So how do you do millions and millions of loans a month with no paper and instant disbursal while maintaining credit and driving profitability? So this is the proverbial iceberg, right? This is the proverbial iceberg. What people see, customer delight and profitability. And I assume you have invited me to speak here because a lot of people see Bajaj Finance and they see customer delight and they see lots of profitability. What you really hear as well is to know what you don't see, right? That's what I'm going to talk about. What is it that you don't see in our story? So what lies beneath the iceberg? 3 things I'm going to offer. The first is in the title of the presentation itself. Analytics. I mean, the title of the presentation is using analytics to drive profitability and growth. So without saying analytics is one of the items at the core, it's not the sole item. Why is analytics at the core? If you're going to underwrite millions of customers in thousands of locations and in 50,000 plus distribution points, I didn't refer that earlier. We're present in over 50,000 points of distribution. You have to do it consistently. Even if you put an army and if you hired 50,000 underwriters, each of them would do it differently. It has to be analytic-led if you want any control and consistency when you do millions of loans at thousands of locations in tens of thousands of distribution points. But is analytics the sole part of it? I'm here to talk about analytics, but I'll tell you analytics in itself is not enough. It is not enough. What do you need? You need processes. You need to drive customer delight through speed. Customers, I think Satish referred to it, they don't come to take a consumer durable loan. Not a single customer has walked in saying, I want a consumer durable loan, right? They want a new fridge, they want a 60-inch TV to watch IPL, they want the latest iPhone 10, whatever it is. And in the point of sale, in the sales finance business, customer delight comes through speed. And the best customers demand delight. And there's a lot of back and forth in a previous presentation about is it causality, reverse causality, dual causality, so on and so forth. But let's get to the crux of it. If you're not fast, the best customer leaves you. So whether or not the best customers are positively selecting, being slow is adversely selecting. I see Rajesh laughing. I know HDFC Bank dominates. They agree with this, right? So that is the crux of it. You have to have processes that enable the analytics to drive customer delight through speed. But is this enough as well? I'll offer there is a third leg, at least in our tech, which is technology. If you have to do this, if you have to underwrite in the peak day of Dhanteras, tens of thousands of loans every hour, tens of thousands an hour. Now let me just step back. It's worth making this point. How many of you are aware of the Singles Day loan in China? Singles Day is 11/11. People are aware of Thanksgiving Day sales in the US. That does only $4 billion of loans. All retailers put together. Alibaba does 24 billion transactions, just Alibaba in that one day. They were processing 2 lakh transactions a second. So as much as we are fast, they are 2 orders of magnitude faster than us. How do you do it, right? Technology lies at the heart of it. It's not enough to have analytics. It's not enough to have processes. You need a technology foundation. So really it's analytics, processes, technology. If you build the technology with the processes, with the analytics, you create the proverbial moat around the business. It's a nice way of saying competitive advantage, but yeah, so that's really what. So what does drive customer delight and velocity? It is the sweet spot. You got to get A plus B plus C right. Analytics alone will not do. You have to get all of these. That is what lies below the iceberg. A couple of people said we are here to learn how Bajaj Finance does it. And if you really learned it, I wouldn't be speaking. So I would be doing my company a disadvantage. But at a high level, if you had to get it, this is it, right? It's at the sweet spot that it lies. I will dwell a little bit more. What do we mean by analytics, right? But before we get into what do we mean by analytics, the biggest mistake people make in analytics is thinking of it without the construct of what the underlying business model is. When you're lending 25,000 rupee loans to millions of customers, our benchmark is actually not the lending businesses at all. At heart, we are at a retail business. We are at a retail business, not a lending business in sales finance. Retail businesses really rely only on two things. They rely on two things as a business construct. A, you need a customer franchise, and I've already talked about the franchise. B, you need distribution. So before anything else, retail businesses are only about two things. A competition here, not a competition, a benchmark of how you do here is not other banks. You got to see how Unilever runs its business model here or P&G does it in the US. Success in retail relies on franchise and distribution. So the context of analytics, which matters, is how do I deliver for millions of customers a month for 25 million franchise across 50,000 distribution points, across 1,000 or 2,000 locations. That is the construct which we have to be clear on. So how do we do it in analytics? First, 8 A scores. How do you know what A score is? A score actually stands for application scores. A new customer comes in, you got to score them. Why do we have 8 A scores? Why not just 1 A score? The reason is this. As you go from tier 1 to tier 2 to tier 3 cities across new to credit, existing to credit customers, if I had the same model for a Bombay thick credit customer, for a Sholapur thin credit customer, you can be sure that the model will not capture all the insights. You will have significant omitted variable bias. I had back and forth with somebody in my team. It's a version of heteroscedasticity I offer, which is a point about variables breaking down across population groups. We have 8 different application scores all running live. So depending on what customer category you are, in which location, you will be run across one or another application score. 8 O scores is one manifestation of analytics that we have. We have 4 B scores as well. B scores are behavioral scores, right? Half our customers, a full half our customers are returning customers. Half our loans are returning customers. I talked to you about EMI cards, so on. Again, for behavioral scores, you want to have analytics to underwrite existing customers. Or new performance is much, much more important. And not just true for us, I think across the world, and I've worked in many countries across the world, behavioral scorecards are always much more powerful than application scorecards because honors information is more powerful than generic demog or offers information. So we have, again, 4 B scores, same reason. Different populations, different uses, leveraged product, non-leveraged products, all of those have different. We have 4 different B scores. We have A scores and B scores. We need C scores. C score here, I think there's an icon, TU. This actually C here refers to CIBIL scores. Why am I saying 3 scores? We use the CIBIL score, of course, directly. But that alone is not enough. The credit vision variables are useful, quite powerful, I think, in segments, and we have started to use that as well. But a third is our own proprietary. If you are an analytic company worth our salt, we don't just take scores. We take the trade level logins and we create our own codified variables which are proprietary to us. So the point is, if you really understand it, you've got to use both the variables that you get from our partner like CIBIL and as well as what we codify. Those are the 3 C scores. You have C scores, you have D score, 1 D score. D score here is really demographic score. It's more a set of policy rules, especially if you get new to credit customers with no background, you end up relying on basic demogs, right? Generally, older married individuals are lower risk than a 23-year-old young man who wants to buy an iPhone 10. Chances are he is going to go bust. So that's the demog scores that are in production. A, B, C, D, but no E. You're going directly to F scores. In our business, fraud risk matters. Fraud risk matters heavily because your assets, especially things like mobile phones, are as good as money. The fact that you lend in 3 minutes means we are a target both of individuals who don't want to pay us back as well as fraud rings. You have to actively manage it. We have And fraud is a matter of two things. It's a matter of patterns and it's a matter of outliers. And it's a matter of customers and it's a matter of distributors, right, or dealers in this case. You have to use traditional models for patterns and machine learning models for outlier analysis. Outlier, because if there is a store whose entire purchase pattern is fundamentally different from everybody else other than them, if somebody in my store in Lower Parel sold only Sony 48-inch TVs in the day, 20 of them, chances are somebody is gaming your system. You got to watch it. So fraud scores really is 2 by 2. Consumer fraud score, dealer fraud score, traditional model, machine learning model, all of them have to run. Machine learning is a much abused term, but I'd like to say this is actually an area where it adds tremendous value because the real value of machine learning is in finding outlier patterns. I think they're very, very powerful. This is really what we have to use. Now, what does it take? This is just the outcome. Our secret sauce, the way we look at analytics, I'll just cover that in one slide. How do you conceptualize analytics? It's not just enough, again I will caution, to throw a bunch of things inside and say I've run AI or run ML. I'm hugely skeptical of those approaches. Analytics works well in a construct. How do we conceptualize analytics? First and foremost, it starts with a solution stack. This is our solution stack. Every year we rewrite and we rerun and we keep adding to these bricks. You got to know what you want to achieve, right? That's the solution stack. And in order to achieve it, analytic solutions are a function of 4 things. First and foremost, what is the infrastructure that you want to invest in? This infrastructure is in the context of the solutions that you want to deliver. What are the processes that you need to build? You will see that I come back again and again and again to processes. As we grow ever larger, I'm an ever greater fan of better processes and managing operational risk. Right? These are the points that matter to us. What are the tools that you need to invest in? And what are the skills that you need to build? So if you have to deliver those outcomes, this is what we do. What are the solutions? What are the infrastructure? What are the processes? What are the tools? What are the skills? This is the secret sauce of our analytics. But as I said, analytics alone is not enough. Processes matter. I mentioned that I'm a big fan of processes, right? And I keep telling my teams I hate dirty processes. I hate dirty processes. So somebody asked me, what is a dirty process? And I hate when people ask me tough questions. But nevertheless, had to come out with an answer. So we said dirty process consists of 3 things. 3 things. It consists of paper, it consists of touch, and it consists of tat. Anything that takes lots of paper is dirty. Anything with heavy touch. Physical touch is dirty. Heavy digital touch is dirty. And anything that takes time is bad. We define our processes as anti-paper, anti-touch, anti-tat. If you define these as bad, what do you aim to do? Move from 20 pages to 5 pages to 0 pages. That's our journey. Move from heavy touch. There was a time when you would have a verifier in a Hawaii chapel knock on your neighbor's door. That was the height of intelligence that was applied. To a point when we, of course, don't do any verification, but you got to go to 0 touch. If you do all of these, you can go to instant. The goal is instant. The ideal vision of a process, 0 paper, 0 touch, instant tat. And you got to do it, of course, in the context of managing your risk. But that's the holy grail that we are after. There's a second piece to it on positive selection. We obsess about processes because good processes deliver great customers. And I think this point that Amrita was making was bang on correct in my experience as well. I firmly believe the worse your process, the higher your risk. Very, very clear on it. The faster processes deliver, irrespective of causality, reverse causality, and dual causality. From a common sense perspective, we believe this. We obsess about it. We measure NPS, Net Promoter Score. It's one of the key metrics that a lot of people use. You can have a score from -100 to 100. -100 means you have the absolute most despicable process in the world. 100, nobody is achieved, but it's the greatest. Financial services industry globally, any ideas? It's actually negative. So we're not a much loved industry, right? So, and it makes sense. To get into positive territory is good. 50 plus is what you'd consider very, very high and exceptional. Not all our products have these numbers, but sales finance does. And I firmly believe we have such good numbers because our processes rock. And because the processes rock, you get positive selection and risks are low. It's a very interesting point I'm saying. If you actually had a thick paper, high verified, long tat process, you would think with all that heavy underwriting, I'd do well. I offer we do much, much worse. This is customer delight. This is measurable customer delight because we measure NPS actively. So we talked about process. The last piece is technology, right? What do we care about in technology? First and foremost, agility. We believe we are the first people to move to cloud-based. Our underwriting process on the cloud, we've been on it for almost 10 years, gives us tremendous scale. You can't underwrite the volumes of tens of thousands of accounts an hour if you're not on the cloud. API integrations matter because the ecosystem is evolving. For real-time instantaneous decisions, your APIs and your API teams have to be at work. It sounds simple, but it's a capability companies need to build, right? That's how you deliver, that's how you leverage the ecosystem. Together, these deliver agility. We care about scalability. Having a business rule engine that's easy to configure helps. Our own EMI network is really our portfolio management tools. This is what delivers scale. Last is capabilities. Capabilities are innumerable. Two that I'm calling out, which are top priority for us. Moving on, away, SMSs are dead. I don't think anybody in this room loves getting the 35 SMSs a day they get from various loan providers and so on. Bots are a fantastic experience. We are heavily invested in getting bots done. Flexi is for us a line proposition instead of a loan. These are just examples of capabilities. Technology delivers the stack. If I had to summarize what I thought this meeting was about, how do you deliver customer obsession and profitability? It said using analytics, but it's not just analytics. It's the sweet spot of analytics and process and technology. And it's only if you get the sweet spot that you will succeed. This was so far. What lies ahead? I think the Indian ecosystem is evolving. Everybody's talking about the Aadhaar stack, right? But let me start. First and foremost, the number of new customers. Mr. Nair said you're adding 6 million a quarter, which is a phenomenally high number. That's more customers than most countries have in their entire credit bureaus. India is on target to cross 1 billion smartphones. What does that mean for how we deliver to our customers? The underlying technology and processes again change. Aadhaar, of course, everybody knows the Aadhaar story now. UPI, and like I said, I worked in the US, I worked in the Middle East, I've overseen products in Canada and UK. I don't think anybody has a platform for payments that is not just inferior, they're all significantly inferior to what we have. I think it's going to fundamentally transform what we have. Digital logger, GST as well, I think from a bank analytic perspective, it's still data is too thin to start using it in a big way, but I do believe as it stabilizes very soon, in as soon as 12 to 18 months, it can fundamentally transform our underwriting. As we sit as a company, what does that mean for us? The single biggest theme we run as a company is data is the new oil. For those of you who read The Economist, it was the title of a cover page about a year ago, really resonated with us. The whole point is how do you get data? By the way, it's only if you extract this oil that you can give pre-approved customer for instant TAT and so on and so forth without blowing up risk. Today I could do it, right? No paper, instant TAT, whatever. It's just that I wouldn't be in this job, so I wouldn't be with you next year if we did that. You do it by investing in the ecosystem to get it done. But there's no point just capturing data. You need deeper insights. This is a place where the talk about machine learning and artificial intelligence has a big role, right? Data itself is crude. How do you refine the data? You refine it, well, refineries are the way crude is extracted. Machine learning and artificial intelligence is what will convert raw data into usable feature. Feature extraction is the primary area of focus that goes hand in hand with data as oil. What do you do with all of that? The offerings have to get more and more personalized. Many of you might have heard in analytics, the holy grail is a segment of one. It's a nice term, but it's actually doable with the right horsepower, because only with the right segment of one do you personalize offerings. If you personalize offering, the best customers take your loan. I go back, how do you drive customer delight and profitability? The worst customers make do with the worst offerings and the worst processes. Hence, if your processes are bad and your analytics bad and your technology bad, you will adversely select. Personalized offerings comes with tremendous positive selection. This drives towards the paperless, presence-less, cashless experience, which is the Aadhaar term that Nandan Nilekani has talked about, very closely resonating with the paper, touch, and tact point that I was making. If you do all of these, customer delight follows. And if customer delight follows, and only if your customers are truly happy and you book millions and millions and millions of customers, You book millions and millions and millions of customers, positive selection is an obvious outcome. And if you get positive selection, an improved bottom line. That, ladies and gentlemen, in short, is our story of how we drive customer delight and profitability through analytics. Thank you. Any questions? Okay, thank you.
Thank you once again, Mr. Vasudevan. And that was indeed an insightful presentation.